Hi everyone, welcome to our event. Thank you for all joining. In today's discussion, the panelists will be sharing details on the role and the impact of technology on the investment industry. Technology is constantly evolving, so I think it will be a really interesting topic to explore. And I'd now like to hand over to our moderator, Christina.
Hi, thank you all for joining, and thank you, Shimeni, for organizing. We have 4 wonderful speakers lined up today. So our first speaker is Alison Porter. She's a portfolio manager at Janus Henderson, a position she's held since 2014. Alison is responsible for co-managing the Global Technology Leader Strategy and a range of institutional fund and the Sustainable Future Technologies Fund. Our second speaker is Sandra Grease. Sandra is a data scientist and data engineer at Independent Franchise Partners. She has 8 years of data science experience and worked as a data scientist at several startups, including Temporal, Treatwell, and List. Marianne O is our third speaker. Marianne is a co-founder and partner at Lumen Global Investments, and she also co-chairs 100 Women in Finance in Northern California. Our fourth speaker is Helen Steers. Helen is the partner in Patheon's European investment team and Patheon's senior management for the listed investment company, Pantheon International. Helen is also the co-founder and board member of Level 20, a nonprofit organization established to inspire women to join and succeed in the private equity industry. I'm going to hand over to Helen to give us more information about her background and also an overview of her day-to-day role at Patheon.
Thank you very much, Christina, and I'm really pleased to be here today, and thanks for inviting us all. So a little bit more background on myself. I actually started out as an engineer many years ago, and then moved into the venture capital and private equity industry. So I actually started as a techie and then moved into asset management. My day-to-day role is really all about investment decision making. So I'm an investment partner. I sit on a number of different investment committees and have to approve new investments pretty much every day of the week. In terms of use of technology, I think it's really transformed our industry. I'm in the venture capital and private equity industry, which always used to be characterized as a bit of an apprenticeship business, where it's a lot about gut feel and you know how you feel about things. I think nowadays a lot more is really data-based, a lot more analytics going into investment decision-making processes, which I think is a very good thing. So we use data in lots of different ways at Pantheon. We have a lot of data on our portfolio companies. We literally have more than 10,000 companies in our portfolios, and we can gather all that data, analyze it, use it to predict trends, which can help us make better investment decisions in the future. But we also use data in other ways. We use it to help us source new deals in the future, conduct due diligence, monitor our portfolios, and then also actually to report to our clients. We use all sorts of technology and processes to help make us better suppliers of information to our investors and build better portfolios at the end of the day. So that's a very brief introduction. I'm very happy to go into any of those topics later on.
Thank you, Helen. Yeah, we'll have time to dive deeper into those topics. Marianne, can you give us a brief introduction to your background and day-to-day role?
Yeah. So thank you so much for having me. Really appreciate this opportunity, and especially along with other talented women in our field. So I'm Marianne O. I am actually originally from Hong Kong. I did my undergraduate in the UK at Cambridge doing economics. So with economics, I easily get into the field of finance when I went back to Hong Kong to work in a bank. But later on, I really think that investment management is really what I really want to do. And I ended up starting after my MBA at Berkeley in San Francisco Bay Area with a mutual fund company, also a UK company in emerging market fixed income. So that is really the beginning of my career, which is in a very niche area of emerging market debt, analyzing sovereign fixed income, basically all around the world. But in terms of my day-to-day role, we have evolved from a pure fund management company in our previous firm to now my own firm, which is called Lumen Global Investments. So we are not just a traditional fund management company, but also an invest tech. So you probably heard about fintech. One area of focus for us is definitely technology applied to investment management. And I'm sure we'll talk a lot about that. Essentially, what we have done is to put our entire investment process onto the cloud. And with our invest tech, we really hope to bring the most essential data and the tools together with our valuation methodology, which we focus a lot on intrinsic valuation, to really bring them all together and help the wealth management industry to do to generate ideas, investment ideas globally, do asset allocation and portfolio construction, and manage risk.
Thank you, Marianne.
Thank you.
And Sandra, you come at this from a slightly different angle. So you're a data scientist in investment management. Can you tell us a bit more about your background and day-to-day role?
Yes, happily. Thanks, Christina, and thanks for having me. So I definitely do come from a different angle in this case. I work for Independent Franchise Partners, who are a London-based public global equity fund. But I come from a more technical background in that sense. I started my career as an astrophysicist, so very academic. And like many, I would say, data scientists and data engineers and developers who have been in the industry for as long as 8 years now, when data science didn't exist as a degree, I'd say university, we all have some form of background from say physics or maths or even biology and chemistry, a lot of basically STEM subjects. And I started off actually my career in startups, as you mentioned earlier. Worked a lot with e-commerce startups mainly, very heavy on data, a lot of development, a lot of data analysis and model building. But then 3 years ago, switched to finance when I actually came across Independent Franchise Partners. Did my master's in finance in parallel whilst helping them with their data. And I would say my day-to-day role involves a lot of coding and working with data in general, but in a good way. I'm pretty geeky in that sense. I like coding, but I'd say just very similarly to what Helen described earlier, we use a lot of data to support our investment decisions in general in the fund. So nothing is automated in terms of the final decision that's taken for the investments, but a lot of the data that we can gather is used to support the decisions that the portfolio managers eventually use. And you can think of data in many ways. It could be internal data from our own models in-house. We tend to have a concentrated portfolio. So unlike Helen, it's not 10,000 companies. We have the opposite problem of big data in our case, where we have a very concentrated portfolio and a small, in general, like investable universe. So we would probably, I'd say my day-to-day role is slightly, like the challenges are slightly different to other people's challenges in the industry. But overall, I would, I can say that there's internal data and external data. And I think we'll touch on many of those, at least external data sets that I'm sure a lot of people hear of all the time in the industry, whether it's natural language processing data sets or ESG data sets or whatever it is that is weird and wonderful out there that can be used on the companies that we're interested in. So yeah, that's pretty much what I do every day.
And Alison, you're with sort of a traditional big investment house. Can you tell us more about your day-to-day role and also a bit more information on your background as well, please?
Yeah, hi, and thank you for having me. I am the fund manager on the Global Technology Leaders Strategy at Janus Henderson. The Global Technology Leaders Strategy is focused just on what it says, which is that technology leaders were looking at many of the large cap companies from Facebook, Alphabet, Amazon, many of the names that you will have heard of. And I also run a sustainable future technologies fund, which is really many companies at the other end of the spectrum. And that's a similar investment focus on investing in technology companies, but with one significant difference is that all of those companies have to have at least 50% of their sales that have a positive impact on the environment or social welfare. So we're investing across the technology spectrum. And interestingly, one of the things that we look for day to day when we're finding new technology leaders, when we're finding new companies, is we tend to look for industries where they don't use much technology, where there isn't much data as such, because those are the industries that are ripe for disruption. Actually, financial services, because it's very regulated, tend to have a lot of data and a lot of technology, which is evolving, but they've had that over many years. Whereas sectors like dating, we've been invested in Match.com, the owner of Tinder, things that have been offline that are being brought into a digital world where you have a very large opportunity. So that's some of the areas that we would look at. I sort of flowed into investment management. I was a checkout operator at Asda when I was at school, and I knew that I really wasn't very good at it. And I joined a union because I felt I was very badly paid. And in joining the union, that followed me into politics at university. Having done politics at university, I decided that actually economics was much more interesting and more impactful. And I ended up doing some academic work at a university and looking at developing economics. And I saw an advert that said, this was a job where you could travel and meet people. And I thought that sounded quite interesting. And that's how I ended up at a very small investment management house and started analysing US equities in 1995, so 26 years ago now. Then, nobody else really used technology. And when you think about how technology has changed, and I'll sound like an absolute dinosaur here, when I started, my first job was to go and take the faxes. A fax, some people listening in might not even know what a fax is, but I got the paper transcripts because there was no email, and I would highlight anything that I thought was important for fund managers, and I would take that over, and that was my job day to day. And then we had the .com boom, and all of a sudden news traveled so much more quickly. So when people look back to the .com boom, and some of the hype that we see around technology now, I can't express enough how different it is, because the flow of information, and when I think about technology really within our industry, I think about there's so many different aspects of how it's used. There's the automation part, bringing lots of data and making more things automated. But one of the most important and interesting factors is the democratization. And many people who are on here have used a Robinhood account before, or have used other trading accounts. And this is just the democratization of information that's been held for just a few people for far too long, and everyone has it. And the real skill in going forward, I think, is also in the decision making and what we do with all of that data, because there's so much. And that's many people on the panel here who have great input on what we do with all that data. There's no lack of data. We've got far too much of it. And my job is really distinguishing between what's real signals, real trends, how to extrapolate it, and what's just noise, and so much data that's out there.
Great.
Happy to get into all of that.
Thank you for the introduction. So I think we'll start with a very broad question. We had some mentioned of external and internal data. And Helen, you've mentioned you have 10,000 companies in your coverage. That's an insane number. So can you tell us how you use technology to kind of find opportunities, trends, and signal in that data set, and how you also integrate external data with that?
Yeah, absolutely. And I probably should have been maybe a little bit more precise when I talked about it at the beginning, because we invest in private companies. So these are not on the stock market, and these can be anything from entrepreneur-backed businesses, family-owned businesses, all the way through to some quite large private companies, but they're not public companies. So our coverage is absolutely enormous. It's actually bigger than the public company universe, and it spans every sector from technology, which is still a very large part of what we do. It's about 30% of what we do, but through all the other sectors, which are all touched by technology. So whether it's healthcare or consumer or industrials or financials, everything is really touched by technology. And I'm actually struck by what Alison said a couple of minutes ago, because what we're looking for as well are the disruptors, and we're looking for them at really early stages before these companies ever think about going public. So it's an absolutely massive universe. There's lots of signals, lots of data out there, and we have to be really disciplined actually in sort of separating out that noise from the things that we're really looking for. So how do we do it? Well, we've got massive systems that help us sort of sort through the data, but we also we use this data actually to help us ask better questions. So when we go in and meet a company, and when we meet the management teams, having all that data just helps us concentrate our minds and be able to ask better questions to the management teams, and really to sort of make the most of that time that we have in front of people. But it's not just actually about the initial investment decisions, it's also about how we monitor the portfolios, and then, as I mentioned earlier, how we operate, and then how we report to our clients. And it's an ongoing process. When we invest in a private company, we can hold that private company actually for many, many years. We've got some companies that have been in our portfolios for sort of 15 years. So sometimes very, very long sort of holding periods. And all through that time, we're obviously interested in operating performance, in revenues and cash flow and profits and all of that. But also we're interested in the impact the companies are having on their local communities. We're looking for the E, the S and the G. So just to give you an example of one of the systems that we use internally, we use an artificial intelligence tool to scrape all the data on underlying portfolio companies, and to really alert us to any ESG incidents that might occur with any of these companies across the world. And we do that by using this tool, which basically scrapes data from all the physical and social media outlets all over the world. So if something comes up, for example, one of our portfolio companies is in the fish farming business in Norway. They had an incident a little while ago with their subsidiary in Chile, and this incident was picked up in the local Chilean Spanish language press. We got an alert that they had a problem with the fish farm. It was an environmental problem, and we could sort of take action at that point. So that's just an example of how you can use better data to help you sort of get to the nub of an issue and sort it out. But we also use data in other ways. We use it to help construct portfolios for our clients. So we can actually construct quite customized, bespoke portfolios, and we can use that using quite advanced portfolio construction techniques. And then we can put together these client reports, which can focus on the areas that the clients are really interested in. So those are just a few examples of how we use data and how they can contribute to better decision making, to better monitoring, and also to better reporting for our clients.
Thank you. That's a really useful insight. And I guess I will follow up with Marianne. You use data in a kind of a different way, kind of to value, to come up with a valuation algorithm, sort of to say. And can you tell us a bit more about that and how that works?
Yeah, thank you for asking. Throughout our career, we are always searching for the right way to look at valuation in a market. It could be a market, it could be a country, it could be a stock, it could be a sector, and now you have exchange traded funds. So all of this. So a lot of, as you already know, a lot of the professionals love to focus on multiples. And these are the price earning ratio and price to book ratio, and could be EV, EBITDA, and to look at, they're all very, good, but to us, however, they are more momentum indicators than valuation indicators. And so we keep on searching on the right way of looking at intrinsic valuation, because if you remember, if you know Warren Buffett, the great focus on using the margin of safety to look at any investments. And one of the things he said that, if people ask him, how do you value a company? They definitely just say, well, it's really the discounted cash flow from the future back to the present, obviously at the appropriate discount rate. And so we take that to heart, because a lot of people in our industry might use a lot of, as I said before, multiples and comparisons, but really you really want to know whether this investment have intrinsic valuation, intrinsic value, how much you can hold on, how much is it before it reaches a target price. And so we take that concept of sort of the net present value, in all your financial classes. And but the key question is, what is the discount rate you discount any investments? Because if you use the risk-free rate and discount everything in the whole world, then it may not be appropriate. For example, South Africa versus Indonesia versus the US, obviously they have very different discount rate. Now, so our main focus is really know what is already priced in the market. So our intrinsic valuation methodology is essentially a multi-stage dividend discount model. So basically discounting cash flow from anything, a country, a stock, a sector, anything, same methodology. Long-term cash flow back to the present, and then find the implied discount rate. And that discount rate is your expected return, really. So we really use this methodology to value any investments in the public markets, and we could use it for private if we have the right data. And we feed real time, including market multiples, because market multiples have under a lot of embedded profitability and growth and ROE assumption in the multiples, and we use those as input to our algorithm. So I'll stop there, but basically it is a discounted cash flow methodology that we propagate and use it in everywhere, regions, asset classes. And I would say the one last thing is why we use this methodology is, if you think about it, you really cannot compare stocks and bonds with stocks, earnings yield with a bond yield. They are not apples to apples comparison. And so if we have the intrinsic valuation or the expected return or the IRR of a stock, then you can truly compare to the bond yield, which is also another IRR. So it is a great methodology for us to do asset allocation across any markets.
Thank you, Marianne. So you kind of take old ways of thinking and valuing companies and apply new tools and technologies to the valuation methodology. I'm going to go over to Alison now. A bit like Helen, you look at kind of early stage companies. You mentioned a few IPOs and SPACs. So at that stage, how do you look at data, and how do you use that along with technology in valuing those companies and assessing opportunities?
We don't invest in SPACs. First of all, we do invest in many IPOs, just because the SPAC environment just really isn't well regulated yet, in our view. So In terms of IPOs and early companies, very often what we're looking for is what the machines can't find. What Helen said earlier, resonated with, the data helps us ask better questions, but what we're actually trying to invest in is very often a rate of change and an improvement. We will use a DCF, as Marianne talked about, but we also use much simpler measures like PE and an enterprise value to EBITDA for valuation. And that's quite simply because there's so many different variables that go into what an intrinsic valuation is. And simply that's why when you see interest rates go up or down, it can wipe billions off of share prices because people just change that top line growth rate that really, if you're looking 10 years out, I think, there's a lot of false accuracy could be priced in where you think that something's going to grow. You did think it was going to grow 20% sales growth for 10 years. And then all of a sudden, if you think it's going to grow 19%, that can change the valuation very significantly. And what we consider as being quite a false narrative. So what we tend to go out, we go to industry conferences, we speak to suppliers globally, and we get a lot of qualitative data back from customers, from clients, on how companies actually operate, what their key ethos is. We meet management. We try to gauge whether management actually say what they actually do, what they say, and whether the narrative matches up to the historical data. And I talked about automation and democratization for data, but the other element is commoditization. And that is data that is publicly available to everyone. So everyone is trying to apply a qualitative edge to that data. It's the decision making you have for that. And that's, as we were discussing just before we came on, I think diversity of thought, diversity of gender, diversity of social background, economic background is so important because that data is available to us all, and we can crunch it, we can use AI and machine learning, but it's our experiences that can help us really add, real value add to what is really an extrapolation, because what our job is as a public and market investor, and for Helen in private markets, is actually looking forward, and you're predicting to the best of your capability what you think is going to happen. And there's very, very many variables that technology can help us take into account, but there's many other variables that as humans with experiences that we can really add value to in that decision making.
Thank you. Thank you for clarifying that. And Sandra, we've talked a lot about using data in our decision-making process. What are some of the drawbacks of using this kind of valuation models and kind of using data as a black box algorithm output?
Yeah, happy to take that. So I think I'll come from two separate angles, and I'll touch on. We spoke about that previously as well in the call, but to carry on from what Alison just said, not just diversity is important, and different backgrounds and knowledge and everything. Sorry, not just different backgrounds and genders and everything in the team, but also I'm speaking from personal experience. Domain knowledge is also essential in terms of the model buildings and the use of data in every single way. Because I entered the finance industry with no domain knowledge at all 3 years ago, and could happily automate a lot of processes and build automated emails and workflows and systems for the team. I didn't actually need to understand what a free cash flow was, but eventually to start talking about AI and machine learning, where we're talking about much more complex systems, you really do need to, that's just AI and machine learning 101. You need to understand the data that you're inputting into the model in order to interpret the output correctly. And as much as it actually does come across as a black box in many ways, because you can build machine learning models in 5 lines of code nowadays. It's I spend, I'd say 80% of my time cleaning data. I'm not like all the code that I write is actually making sure that the data that I'm given or the data that is publicly available as like, it's true. There is a lot of data out there. You need to make sure that it's clean. You need to make sure that it's correct. You need to make sure that it doesn't have any weird underlying signals, especially the time series-based data, depending on how the data was actually processed and made available. Unless you have the luxury to build the systems and track certain things yourself. A lot of the data we get nowadays is, as Alison and Marianne and Helen mentioned, it's commoditized. Like you have to buy it or you have to find it and source it either for free or pay for it. So that's one massive step in terms of I don't want to say drawbacks, it's just part of the process, but I think it's a lot of people underestimate that. You do really need to understand what it is that you're going to eventually feed into the model or build the model on. And then the output itself, I think there's a lot of underestimation of like how to interpret the data itself and the output. Like, what does that signal actually mean? And you can start tweaking a lot of things, overfit your model for it to look great, or vice versa, like realize that you didn't use the correct parameters for it. So you do spend a lot of time, you have to spend a lot of time interpreting the outputs. And I think then the next really difficult part, which I'm speaking from my perspective, given that I'm the one sort of, cleaning the data, building the models, and the output makes sense to me, but then communicating that part to, say, the investment team who don't look at the models, don't really deal with machine learning and AI on a day-to-day basis at all, explaining the output to someone that doesn't have, say, a technical background is actually, I'd say, another difficult part in the process. And it's where you really need to make sure that you do understand it yourself so that you can then explain it. And if at the end of the day, massive investment decisions are made based on those sort of signals and outputs of those models, I think we shouldn't really take any of this lightly, in a way. Not to scare anyone, but I think it's more to, from the beginning to the end, that sort of process where nowadays it's so easy to get an output or to build a model very quickly, but not really to understand what it is that it's actually doing. So yeah, those are my thoughts around the difficult side or the drawbacks as well. Please.
I couldn't agree more. And I think, Sandra, what you're sort of describing is the fact you need to always put things in context. And I think one of the actually fascinating parts of the investment management industry is that it's an art as well as a science. So we've talked a lot about the science and about the data, but there's also an awful lot of qualitative information, and there's an art to it as well. So I talked earlier about meeting management teams and meeting entrepreneurs, meeting these managers, and you can't really replace the body language and the interaction between people. So you can use that data to give you insights, but then actually sort of some of the value added, I think, is the way that you interpret the data, the way you put it in context, and some of sort of the comparisons that you're making. And the other thing I would say is that sometimes data can lead you down a sort of what you think of as a preordained path of some sort, whereas in fact what you're actually looking for is sort of big disruptive factors where the data is actually not continuous, and it is being disrupted. And that actually, as Alison mentioned a little bit earlier, is actually where you can make the really interesting investments, where there's some sort of dislocation that's happening and the future is not going to be like the past. And I think that's actually quite interesting. I mean, we've invested quite a lot in some of these other industries that have been disrupted by technology. We talked earlier about some of the older industries where there's less data, some of the more traditional industries, but for example, in the healthcare industries, health tech, telemedicine, really interesting areas where actually, again, we can improve people's lives through better access to healthcare, and you can do that through digital means. Or we talked a bit about consumer, but there's so many different areas of consumer, you know, online education, for example. A lot of these areas you never thought that you could actually access them through digital means, but now we can, and that's actually transforming some of these investment opportunities.
And Helen, I just wanted to add to that comment you made at the beginning about context, because actually on Alphabet's conference call last week, and we all use, you know, the greatest form of AI every day. Most people use Google in some form. And Google last week talked about, they have a new search model called MUM. It's called it's Multitask Unified Model for contextual search. And that ability to add contextual search around what you've been putting in. They had previously they used an algorithm called BERT, and MUM, because it has context, is 1,000 times more accurate. And you know, I think it's a great example of what context is needed, how machine learning is trying to bring that context in. But what we're trying to do when we're looking forward is very often data leads you to linear paths, and this contextual model and search is a great example of the difference between linear growth and exponential growth. And when you have that linear growth, then it's very easy to predict that something grows 10% every year. But that disruptive factor comes when you get a network effect, when there's an exponential explosion and it changes direction. And that's when the historic data doesn't always pick that up. And that's, as investors, where you're looking for that unappreciated explosion, that unappreciated exponential ramp that you get. Very often people say, oh, but nothing's changed for years and years. And that does happen. And then all of a sudden, you know, you see that real step change in how we do things.
Thank you for that. So data is not an algorithm. It's not just a button we can press and get an answer. It's a bit more work involved in that. So we're a bit over halfway through the discussion panel. So I'm going to ask the attendees if they have any questions to use the Q&A chat function at the bottom. And one of the attendees has kind of preempted the next stage of our discussion around ESG. So their question is, what factors are used in the matrix to evaluate ESG companies? So I'm going to go over to you, Alison, because you mentioned the sustainable fund, which, so just if you could tell us some of the elements and factors you consider for that.
Yeah, so first of all, you know, I think I want to maybe separate the use of ESG, environmental, social, and governance insights, from sustainable investing, because very often when we talk about environmental, social, and governance factors, what you're talking about is, do companies operate in an ethical manner? You know, do they have policies for diversity and inclusion? Are they fair? You know, that's very often what you talk about. But when you talk about sustainable investing, we think about that as being, and actually this is what the new EU regulation is bringing us to, is that this is different, that sustainable investing is where you invest in something where the core operations of that company actually have a positive impact. So the difference between not just how companies operate, but what they actually do as well. So, you know, when we do use a part quant model that can help us assess, you know, how companies are doing things. Do they have science-based targets to get to net carbon zero? What are their carbon emissions? Do they have a deforestation policy? Do they have a nature policy? What is their water management policy? And actually, the EU have laid out these kind of 14 factors, and many of the factors that we use around our algorithm fit around that. And then there's other sorts of areas such as reputational risk, where we use similar types of tools to the one that Helen mentioned, which can pick up, you know, things that can create reputational damage, where there's controversies on a company, where they might not have quite breached rules. Maybe Facebook would be a very good example of that. Facebook is something that we wouldn't invest in a sustainable fund. but you could consider it in other funds that are still ESG aware, because you might choose, as we have, to engage very actively with the company in terms of the policies and practices that they have. So there's a real distinction there. And when we think about sustainable investing, we have 8 core sort of sustainable investment themes. But again, that very much comes down to understanding what companies do. And data hierarchies, just looking at data, can't really tell you qualitatively what a company does. It can tell you that a company is a software company or a hardware company, but what does that software actually do? And we look at companies that might be improving educational standards, companies that might be looking at helping water management, companies that might be providing improved agricultural yields, companies, this is within our sustainable equities funds, and looking at companies that may facilitate and enable the shift to electric vehicles and a low carbon approach. We find it quite easy to automate and find data to pull out on the E, S, and G factors, but very difficult to automate the understanding of sustainability. And sustainability and ESG can be quite different because, for example, we have companies that we invest in who provide parts for solar panels, so the electronic chips that go into solar panels. And that's part of, really democratizing renewable energy. So if just like democratizing PCs, you needed an Intel chip and a computer chip to help make it cheaper, and people do that, and more people to have access to that. And it's the same with solar panels, but many of those solar chips, they require parts and raw materials that come from parts of the world, from areas in China where you have human rights violations. So you then have lots of dilemmas where you want to support environmental goals, but where you also want to support social goals. So it's very difficult in terms of sustainable investing to use any kind of quant or data model or matrix that can pick up those type of factors. You really need to research that fundamentally yourself.
Thank you. Indeed, it is very difficult to integrate ESG factors into evaluations. Marianne, I'm going to go to you. And you talked about kind of a traditional way of valuing companies and applying modern tools to it. How do you look at ESG factors in your evaluation process?
So while we don't really have a ESG mandate or a particular ESG focus, however, I think there is no doubt that the ESG needs to be integrated somehow, not just in the investment process, but probably in the investment firm. The most important, as I agree with all the panelists, is the diversity of thoughts and the diversity of background. In fact, a lot of our the people that come into our industry actually have very interesting background. I've met people who have a music degree, who have artistic degree, apart from all the economics and financial and art history degree. And I think it really speaks to the wonderful diversity of thoughts. But in terms of the investment process, I think the challenge for us is the standards of evaluating the E, S, and G. And if we look at the traditional way of looking at investment valuation, a lot of time we really focus on financial performances. So there's no doubt that now you really need to understand how the integration between the sustainability aspect of your investment would affect your financial return. If we can answer that question, I think the ESG will be totally integrated with probably in our industry even much better, because we talk about this concept for a long time, but now I guess given the last couple of years what has been happening to our world, the social aspect, the environmental aspect really got focused. A lot of time we focus on the governance aspect in investment management, meaning good corporate governance and all that in our decision making. But now the E and S is absolutely very, very important. And so I think to us, we're still learning, we're still exploring, we're understanding different protocols. You know, the EU has a different protocols of looking at ESG than the US. Maybe separate standards will continue. And luckily, we have a lot of existing system that really focus on this area, like MSCI, Bloomberg, Sustainalytics, and the SASB. So now we have a lot more tools than 5 years ago as a more standardized measure for different metrics. And I think that one of the challenges is that each company will report different types of ESG metrics. And so you have to really understand your industry to know what really is important for that particular industry. You know, not to just have a blanket comparison of ESG factors across, you know, all the companies. So that's make it very challenging. It's unlike financial data, you can do a more almost a more easier comparison across the board. But for ESG, it's very specific to the industry, for the company, and yes. So I think there's a constant learning process.
And it's even harder with private companies because there's less data out there, and there's really no standardization at all at the moment. So it's a big challenge that you know, we're trying to shape, because we've been one of the longest established sort of ESG advocates in the private markets industry. The other thing that we're trying to do is to actually look for, and Alison mentioned this as well, is to look for sort of, you know, positive impact companies where you can use ESG to actually create value. So investing in companies that are involved in filtering, for example, or in energy metering, those sorts of areas. And on the social side as well, we've got, you know, all sorts of companies that are involved in things like you know, education and healthcare management, again, in sort of democratization, bringing services to people that might not actually have access to them. And that's actually a big investment opportunity as well, because there are hundreds of millions of people that don't have access to the sort of services that we have on an everyday basis. So I think there are opportunities there as well as challenges.
Christina, it might be a segue into what's one of your other questions, that, you know, we speak to many large cap companies, and cloud computing is a huge part of the shift in technology. And when we speak to Alphabet, Amazon, AWS, and Azure from Microsoft, what they're trying to do is to shift very rapidly to net carbon zero and provide tools. Both Microsoft and Alphabet announced tools last week to allow all smaller companies that are based on the cloud to be able to provide data on emissions. And we've never had that before. So being able to get the right data on that can help them target net carbon zero. So, you know, those large cap companies can really facilitate sustainability and the shift to net carbon zero.
That's great. Thank you for the insights. And I'm just going to finish this question with Sandra. I think you can give us an idea of the challenges that are involved with integrating those kind of qualitative tools into the process. So.
Sure. So from my perspective, I think my biggest struggle with the biggest challenges I've had with ESG data in general has been the lack of standardization between I'm going to call them the scores, or like the ESG scores that we have on different companies. So depending on where you're getting your data from, Marianne mentioned, like, you've got MSCI who are you know, really big on that front, but you know, you've also got Sustainalytics and many other different sort of companies that are trying to provide some form of ESG metrics on the different, at least on the public company side. I can't speak for the private equity sector at all. It's really hard to draw conclusions out of data that's not standardized, basically across the platforms. And then the other challenge that actually is quite a big one in when it comes to the models and everything is the lack of history. ESG is, I'd say, a fairly recent hot topic in that sense, compared to a lot of other fundamental data. And, you know, you could get close prices of companies that go as far back as when they IPO'd in the 90s or the 80s. And, you know, a lot of fundamental information on public companies can go as far back as literally the 60s and 70s. And if you want to try to include many regimes and see whether this is like anyway a signal at all, or if your returns are going to remain as good or not, ESG data is not that existent in terms of history. And that's, I think, another massive challenge that the industry faces for now, at least on the public side. So yeah, I think those are my thoughts around the ESG data and the challenges.
Thank you. And we're down to the final 10 minutes. So I'm going to ask the attendees again if they have any questions to put them in the Q&A chat. And we got kind of a broad question from one of the attendees asking about the inevitable long-term impact of COVID-19 for the financial sector. So I'm going to go over to Helen. Arguably, private companies have been one of the hardest hit by COVID. So from your experience, what kind of long-term trends do you see?
I think there's two broad sets of impact here. First of all, because of COVID-19, you know, central governments around the world, you know, unleashed, you know, all of this quantitative easing, you know, basically, you know, printing money. And that's had a, if you think about the impact on the financial sector and the investment management industry, that's caused, you know, asset prices to rise right across the world. So whether it's equity prices or whether it's housing, you know, real assets, that's caused this sort of enormous ballooning in asset prices. And, you know, frankly, at this point, you know, I don't know whether the policy makers actually know their way out of it yet. People are now talking about inflation. Is it transitory or is it going to be long lasting? What sort of impact is that going to have on the financial sector? So I think that's sort of one set of sort of more broad, you know, macroeconomic concerns for the financial sector. In terms of sort of the other set of impacts on companies, I think actually if you think about where we invest, and I mentioned at the beginning that about 30% of what we do is information technology, about another 20% is healthcare, and then we've got about another 20% in consumer, but in online consumer, e-commerce, online marketplaces, and services and staples. And actually those sectors were actually, some of them were actually accelerated by COVID. So if you think about it in the information technology sector, businesses having to suddenly operate remotely, a lot more emphasis on process automation, on people being able to do things at a distance, all of that. So in fact, a lot of our information technology businesses actually had a very good crisis. The same goes for e-commerce and online marketplaces, online delivery of services. You know, all of a sudden, everything was online. So a lot of those businesses actually did very well through the pandemic. Even the healthcare businesses, some of which had to shut down at the beginning because clinics, physical facilities couldn't operate, have now really been able to sort of make up for lost time, because for example, if you've invested in a chain of dental clinics, as we've done, or in veterinary surgeries, there's only so much time you can sort of put off doing dental work or having your pet treated. So a lot of this actually is then sort of come back, and really it was just, I suppose, the physical businesses, in particular, retail stores, travel, hospitality, leisure, that was very badly impacted. And I think the jury is out a little bit on what's going to happen there in the future too. So I think it's very much sector dependent as to the impact on businesses, and the private companies are probably very similar to public companies in that regard. It's much more sort of sector dependent, and I suppose geographic dependent as well, because clearly things have affected different countries at different times, different parts of the world, different sectors. So maybe one of the economists on the panel might be able to help answer the question about, what's going to happen with QE and inflation in the future.
I think it's well said, Helen, on the the uncertainty of the QE, because I think the interesting thing about QE is, even though there might be some tapering, meaning the Fed will buy less of a treasury, but they are still buying a lot of treasury. So a lot of times the market focus on the tapering, but in fact the liquidity provision is still there. So it will be a gradual process. But on another question, back to the original question, I hope to add a couple more aspects. One is obviously in our financial sector, we have always had the luxury and the benefit of using very structured data, because it's just what we are. And now, because of I think COVID and online and cloud technology being in the forefront, I think this digital transformation is also happening a lot, probably faster in the financial sector. And because then we can not just basically use sort of the structured data, but think about other alternatives data that we can use to help our understanding of making investment decision, and also automate a bit more of not just the investment process, but definitely the operational due diligence side, the regulatory tech, as well as on the wealth management side, the financial planning. So there are a lot more interesting use of technology even there. And so the digital transformation is definitely happening. So firms that do not focus on with use of data and technology can probably be really be at a really big disadvantage. Deloitte have a study that compared the sort of the front runner with the latecomers. The differences could be 5 times as fast in organic growth, much healthier margins, and 25% better client retention. So it is quite serious. The second thing I want to mention, to step back a little bit on the social aspect of the COVID-19. Obviously, it brings forefront the inequity of not just within the different ethnicities. Gender becomes again a lot more also focus, and it's just with my work at 100 Women in Finance, we focus a lot of promoting women fund managers, and so the key is why is that there's so much educated women like all of us, but 2 to 7% of asset management firm are led by women. So this is a very interesting question. I think it will be much more in focus again. And with California, I don't know whether you know that we have regulation that authorize a couple of female directors on the board of directors of California public company. So, and this mandate is going to extend to diverse board of directors. And so I hope after COVID-19, we will definitely accelerate the prominence of women in our industry. And the first thing we need is more women decision makers. So I really encourage all of our audience to think about finance and investment as a career, because once we are in the position of allocating assets, we can help a lot more women founders and diverse entrepreneurs and to really go and change the world.
The numbers in private equity are probably even more shocking than in public equities or in the hedge fund world. It's something like 8% of senior roles in investment management in private equity, 8% are held by women. Absolutely shocking. And then that translates, as you say, Marianne, into female entrepreneurs not being able to get the financing they need because the venture capitalists and the private equity firms are sort of more male dominated. So I absolutely embrace what you say, and it's better for all of us anyway. More diverse groups make better decisions. So whether it's in the underlying portfolio companies or whether it's in the investment management industry, we're better off as a diverse group.
And, you know, not to minimise in any way the horrendous humanitarian impact of COVID-19, but it has brought a flexibility to the way that we work that we haven't had before. And so, you know, I'm in Glasgow today, ahead of COP26, where I'll be attending a whole lot of events over the next week. And in Glasgow, pretty much all of the schools children have been told not to travel, to work at home. People who live in the city centre have been told to work from home because we've been doing it for the last 18 months. So very easily you can control traffic, you can allow for events to happen in a way that we would never have been able to do before. It would have been unthinkable to be able to just tell children to work at home and conduct lessons online. And so there's been a tremendous amount of flexibility that COVID-19 has now brought to our working practices that hopefully has a real positive impact in financial services.
I think that's a very nice note to end on, focusing on the positive for the future. And thank you very much to our panelists for their time and for their insight, and to Gain and Shemani as well for organizing. And I hope you found this useful.
Thank you. Thanks for moderating, Christina.
Thank you very much.
Thank you, Christina. Thanks to everybody.
Thanks. And
I just want to quickly thank everyone, to Christina and all the panelists, for participating in this talk and for sharing all your amazing insights. And I hope everyone enjoyed the discussion and learned something new. And I think that sums up everything. And I hope everyone enjoys the rest of their evening.
Thank you.